After a 3.3% annual growth in the fourth quarter of 2023, America's clouds have finally parted, allowing glimpses of brightness to shine through. The U.S. stock market, which has increased 1.6% so far this year, according to the S&P 500 index, should benefit from such developments. It goes beyond the S&P 500 as well. On January 25, the Dow Jones Industrial Average crossed above 38,000 for the first time. On January 29, the Nasdaq Composite closed at its highest level in the previous 2 years, 15,628.04. On the downside, although expenses are predicted to gradually decline in 2024 by the U.S. Department of Agriculture, customers are still concerned about excessive grocery store pricing. In general, between December 2022 and December 2023, food costs increased by 2.7%. Prices for common kitchen necessities like eggs and lettuce have decreased. However, between 2022 and 2023, the cost of beef and sugar increased. The American consumer isn't raising any champagne glasses to the U.S. economy in early 2024 when you take into account still record-high home prices, labor volatility that has resulted in tens of thousands of layoffs so far in 2024. U.S. technology companies have already laid off nearly 30,000 employees this year, and stagnant wages. What does that signify for the seemingly rising U.S. stock market this year? As of right now, that means more anxiety about household finances in 2024 and more uncertainty heading into a stormy presidential election season in the United States. Which salient features of the 2024 market could push it toward greater depths? These 6 major concerns could have an effect on the financial markets this year. So let's start zero. Number 1. High stock valuations. Even though the current S&P 500 average is trading at 19 times next year's earnings, compared to a 55-year average of 16, the current values are stretched. But assuming interest rate variations continue in the same way, equities should perform well in 2024. Overpriced stock prices may cause issues with stock performance over the remainder of 2024. According to Lisa Shalit, Chief Investment Officer at Morgan Stanley Wealth Management, the S&P 500's current forward price-to-earnings ratio is around 20, compared to about 17 at this time last year, in the company's weekly report for the investment committee released on January 8. Meanwhile, the equity risk premium, the reward an investor can expect for owning stocks over risk-free treasuries, is at an extreme low of about 1 percentage point. You can obtain a more accurate return predictor by extending the present valuation perspective through the end of 2024 and into 2025. On that score, today's valuation levels point to subpar annual stock returns, with gains averaging 4% compared to the long-run average of 7% to 8%, Shalit stated. Number 2. Overdependence on leading stocks. In 2023, Alphabet Incorporated, Amazon.com Incorporated, Apple Incorporated, Meta Platforms Incorporated, Microsoft Corp., NVIDIA Corp., and Tesla Incorporated, also known as the Magnificent Seven, we're the clear winners. As stated in a recent article by David Polak, Equities Investment Director at Capital Group, the Bloomberg Magnificent Seven Total Return Index returned 107% in 2023 compared to the S&P 500's 24% return. This was mainly because of positive corporate fundamentals for the big technology companies for the year. As the S&P 500 is weighted by market capitalization, these companies not only profited from their early AI investments, but they also contributed to the index's rise, according to Kelly Milligan, managing partner at Quorum Private Wealth in Danville, California. There's only one issue. The Magnificent Seven stocks accounted for the majority of last year's stock market gains. Any departure from such level of performance could result in 2024 market underperformance. Number 3. Wishful thinking on interest rates. Investors may be expecting a sharp reduction in interest rates from the Federal Reserve in 2024, but Morgan Stanley's Shalit thinks that may be wishful thinking. The market continues to assume that the Fed will cut rates more quickly and steeply than it has publicly signaled, she stated. Futures markets are pricing more than 6 rate cuts this year, even though the Fed has announced its intention to do so 3 times. That is presuming the central bank will continue to be successful in controlling inflation, but we think labor-intensive service inflation is still likely to continue. Number 4. Consumer exhaustion. Credit card debt is engulfing Americans. Credit card delinquencies rose across the board in Q3 2023, according to the Federal Reserve Bank of Philadelphia. The Philly Fed reported credit card debt delinquent of 30, 60, and 90 days. According to the U.S. Bureau of Economic Analysis, consumer non-mortgage interest payments rose 50% year-over-year to $1 trillion in Q3 2023. The burgeoning living beyond means character of the consumer can most easily be seen when looking at consumers' revolving credit, and the associated increase in serious credit card delinquencies, wrote Charles Schwab investment strategists Liz Ann Saunders and Kevin Gordon in a recent research report. Younger borrowers have higher delinquencies. The ratio of credit card debt to compensation is currently low due to good salary growth, but if wage growth slows, it will rise. Saunders and Gordon emphasized that consumer spending accounted for 70% of GDP, so downbeat sentiment might hurt stocks. Number 5. Stubborn inflation. U.S. Consumer Price Index inflation is 3.4%, although the Fed expects it to decline below 2.5% in 2024, still above its 2% target. The Fed prefers the Personal Consumption Expenditures Price Index to measure inflation. In early 2024, inflation stays strong due to worker pay, according to some economists. According to U.S. Bank, average hourly wages growth is still higher than the Fed desires. If we look at the Fed's definition of progress on inflation, the Fed wants to get it closer to their target of 2% per year, says U.S. Bank Wealth Management Chief Investment Officer Eric Friedman. The question is how much further inflation must level out before the Fed is again willing to change course on interest rates. Number 6. A roiling 2024 presidential election. The 2024 election season has begun with the Republican Party nominating former President Donald Trump and the Democratic Party supporting former President Joe Biden. Given that polling numbers are down for both candidates, that landing suggests more thud than bounce, a critical issue given that major election years have a big impact on the financial markets. Since 1980, stocks have rallied in the year after an election, on average, notes Bell Bank's Bloomington, Minnesota Chief Investment Manager Greg Sweeney. So while volatility may pick up with the unknown heading into an election day, stocks tend to forge ahead as uncertainty fades. While the Fed slows rate rises, market volatility already exacerbated by the election could increase. This means cash carries reinvestment risk, and today's elevated bond yields offer an opportunity to lock in higher income potential for longer. J.P. Morgan Wealth Management investment strategists Madison Fowler and Sean Snyder wrote in a research note. We're most excited about municipal bonds, with their tax treatment offering an even bigger pickup in yield alongside limited default risk. Steps to crash-proof your investment portfolio in 2024. The Fed's higher-for-longer interest rate plan may hurt consumer and company budgets in 2024, but for now, it appears like this year's landing will be uneventful for the U.S. financial markets. In Russell Investments' 2024 Global Market Outlook, President and Chief Investing Officer Kate L. Hillo stated, "We aren't as confident about that, but we still see opportunities in a total portfolio context. Since their returns are higher than inflation, government bonds are becoming more and more desirable as a hedge against stock market volatility. Because of their defensive qualities and relative value, we favor high-quality stocks." Globally listed infrastructure and real estate investment trusts, or REITs, are particularly appealing and should benefit from longer demographic and technology trends, according to L. Hillo. As the year goes on, consumers should also pay close attention to asset allocation because active management and portfolio diversification are crucial in the potentially unpredictable financial market environment of 2024. This goes beyond stocks and bonds and addresses broader macro factors such as inflation, growth, and trade, L. Hillo stated. In this setting, next-generation diversifiers like private loans and real assets provide extra advantages. Diversification on the growth side of portfolios will become more important as monetary policy shifts, but cautiousness will be necessary due to high volatility. One of the most significant trends to watch in 2024 for investors is the breadth of the stock market. That's it for today's video. I hope you find this video informative and helpful for your financial journey this year. Thanks for watching.